Trump next initiative this week after the banning of corporation ownership of single-family homes is to propose that Fannie Mae, he says he's instructed Fannie Mae to go ahead and do this. Now, this one he may not need Congress to codify, I guess.
Yeah, I think I saw it said Pulte's said he's gonna go ahead and do it.
Pulte's just gonna go for this. And I believe that's right, that they can go and do this. So the FHA,
right, yeah.
Fannie, Freddie, sitting on a surplus of funds. There was a report, 159-page report to Congress from the FHA that showcased they're supposed to have basically, I'll simplify this. Supposed to have 2% surplus in funds to protect against things like the Great Financial Crisis. They're up over 11.4%. Highest, it's a record surplus. So you could go back down to kind of where they're supposed to be at that 2% number. You could use some of this money. Trump says, hey, go use $200 billion to purchase $200 billion of mortgage-backed securities in order to potentially lower 30-year fixed mortgage rates. Does this work that way?
So the short answer is yes, absolutely. If they do this, it will make rates go down. A lot of, the Federal Reserve rate cuts get a lot of attention in the media. But what happened in 2008 and what happened again in 2020 during COVID and the Great Financial Recession, the Federal Reserve bought mortgage-backed securities. They sometimes call this quantitative easing. So it absolutely does make mortgage rates go down. It's a big part of the reason why mortgage rates were so low during COVID is that the Federal Reserve pretty much, in an effort to stimulate the economy, to put more money in people's bank accounts, they just made the mortgage rates much lower in attempt to avoid a not a recession, but a depression. I mean, like you think about the Great Depression and how bad things were in the 30s. Like they never want that to happen again. So whenever there's something bad happening in the economy that has a risk to cause something like that, they take action. And I mean, that's part of the reason why we have inflation now is that, things like that were done to avoid the recession being worse. And so the short answer to your question is yes, it will make rates go lower. So I'm guessing your next question is probably is this a good idea? I have mixed feelings about it. If you go back and it's funny, if you go back and listen to this show, we had an episode, I think in 2022, when everybody was talking about like, what are we going to do to get the rates lower? And I was like, nobody's talking about buying mortgage-backed securities. Like, why is nobody discussing this? Like, they could buy the mortgage-backed securities, it would make the rates go down. So I said that on this show in 2022.
Well, they were doing it back then. The Fed was buying everything, mortgage-backed securities. They were buying long-term treasuries. They were buying short-term T-bills, quantitative easing. They were on the extreme end of quantitative easing. The Fed has now started QE again, but it's on the short-term T-bills, not the long-term stuff. Okay. And then they were also buying mortgage-backed securities. They were doing all three. They're not doing mortgage-backed securities right now, the Fed. They're not doing the long-term T-bills. They are doing the short-term. They just started doing the short-term T-bills again. So Trump's trying to fill in with Fannie Mae the two of the three components, the mortgage-backed securities at a $200 billion rate. What really impacted the rates to go down, before they started going back up in 2022, was the purchasing of the long-term T-bills, influencing directly the 10-year treasuries and the 30-year bonds, right? So that has a direct impact. This will, to your point, have a short-term benefit to rates. It really hedges against rates, maybe even moving up on maybe job data. Say you had strong job data. We have some job data here from this week, but there were signs that maybe jobs aren't as soft as they thought, and so that would increase rates. If jobs were stronger, that would actually potentially increase rates, and so this could be a hedge against it. But again, it's just like it was when rates got really low, it's a short-term pop, not a long-term solution to housing affordability.
And $200 billion sounds like a lot of money, but it's not like the Federal Reserve that had an unlimited checkbook
That's right.
to buy tons of mortgages to really make rates go way down. I saw one quote from Kennedy Goldberg, the head of U.S. rate strategy at TD Securities. He was estimating it would make rates go down by 0.25%. I mean, 0.25% is nice. I mean, I'm happy about it. Like, I'm like, great, rates are going to go down. I'm going to do a couple more mortgages. It's going to be a little more affordable, but it's not going to make a huge impact.
It could go down 0.25%, but also the bond market could say, we don't like the financial engineering, and could wash it out.
Totally.
And rates could go up a quarter, and you could be a complete wash.
Could be canceled out real quick by the news of the day.
Yeah. So it's just not just like the Institute. It's something like if a salesperson says to me, Brian, I say to a salesperson that's just starting out, like, hey man, the first thing you should do, make 100 calls and shoot for 20 sales related conversations in those 100 calls. That should be the goal. And if at the end of the day, the salesperson comes to me and says, hey, Byron, guess what? I made 2 calls. Well, it is better than 0. Okay. You did make 2 dials. It's better than 0, but you made 0 impact on the future stability of your growth and your career and what that's going to look like. You made no impact in the marketplace. And it's better than 0. It's a start, but it's a damn near pathetic one. And, these are something, they're not long-term solutions. I get it. Business is operated in America on short-term cycles, 90-day cycles.
I would also argue we should save this tactic for like times of real emergency.
Correct.
Like the economy is doing fine right now. Like we should save this for when,
But it's a midterm election year, so we're not going to do that. All right, Real Estate Radio, we'll be back. We got jobs and how that's going to impact the rates. Everything impacts the rates one way or another.